Gold has shattered every conventional barrier that once defined its limits, climbing from levels below $4,000 just 1 month ago to touch $4,436 this very morning before settling under modest selling pressure near $4,365. What makes this advance truly remarkable is the simultaneous surge in long-term borrowing costs to heights not witnessed since 2007, a development that historically acts as one of the fiercest headwinds against the yellow metal. 30-year yields have climbed to points where governments must now pay rates last seen nearly 2 decades earlier, yet gold continues its upward trajectory without the expected retreat. Something deeper is unfolding in the physical markets for industrial metals, and understanding that dynamic unlocks the true story behind gold's resilience. The London Metal Exchange currently reports holdings of roughly 27,000 tons of copper, with more than half already canceled and scheduled for removal from the system. Aluminum inventories have sunk to their lowest point since 1990, and a single dominant holder controls the overwhelming majority of what remains. Two scarcities are emerging at once: immediately available metal and the willingness of any party to extend 30-year loans at rates acceptable to sovereign borrowers. Whether these pressures share a common root forms the central question of the present moment. Cash copper closed Monday $535 a ton above the 3-month contract, marking the widest backwardation since 2021. Someone is prepared to pay that premium simply to secure metal today rather than later. This behavior typically arises when a participant faces an acute short position, perhaps after trading with clients and discovering a shortfall in physical inventory, or when the prospect of near-term profit outweighs the cost of immediate acquisition. The tightness reflects a market caught between competing forces: robust demand from China's energy transition projects on one side, and tariff uncertainty surrounding shipments into the United States on the other. Even as China's property sector continues its multi-year decline, overall copper consumption there remains firm because the metal sits at the heart of electrification, renewable energy infrastructure, and related industrial expansion. Simultaneously, the risk of tariffs has prompted a rush to move copper onshore before any levy takes effect, since the value of metal already inside the United States would rise by roughly the amount of the duty. The combined effect has shifted inventory balances dramatically. Of all copper held across the 3 major futures exchanges in New York, London, and Shanghai, nearly 70% now resides in COMEX warehouses, an unprecedented concentration. The United States accounts for only 6 or 7% of global copper consumption, yet a disproportionate share of visible stock sits within its borders, starving the London market of available supply and producing the extreme near-term premium observed this week. More than half the metal on the London warehouse list has been canceled, meaning it is booked for withdrawal. Canceled tonnage does not vanish, it moves. Much of it travels by sea, remaining aboard vessels during the transit window required to reach American ports ahead of any potential tariff announcement. Similar rushes occurred last year when anticipation of duties triggered heavy inflows, and a comparable pattern has reappeared. Copper is flowing both eastward and westward as traders exploit arbitrage opportunities created by price differentials between destinations. Industrial demand itself has not suddenly exploded. Rather, large volumes are being repositioned to capture higher prices in one location relative to another. Of all canceled copper worldwide, 63% is located inside the United States, with New Orleans alone holding 45,000 tons, more than 4 out of every 10 canceled tons on the planet. Commerce Department recommendations for a phased tariff on refined copper, 15% in 2027, rising to 30% by 2028, remain unresolved 7 weeks past the original decision deadline. The metal is not disappearing from global inventories so much as it is leaving warrant status in one jurisdiction in anticipation of a rule that is yet to be finalized. Once greater clarity arrives regarding tariffs, prices outside the United States could rise sufficiently, particularly in Asia, where demand stays robust, to reverse the arbitrage and draw metal back out of American warehouses. That reversal failed to materialize after last year's inflows. Virtually none of the copper that entered the United States subsequently left. The risk therefore exists that material now staged inside the country could become stranded, prolonging tightness elsewhere. Visible stocks represent only a partial picture. Trading houses and other entities hold additional unreported inventories, yet the exchange data still provide a reliable snapshot of current stress. Metal registered on the London Metal Exchange, but physically located in the United States, sits outside the domestic tax and regulatory system. Transfer into a COMEX registered warehouse is required before it counts as fully inside the American market. The extreme cash premium concentrates almost entirely on the immediate prompt date that settles tomorrow, the main monthly delivery point. Along the rest of the curve, the stress largely evaporates. The September to 3-month spread stands near $57 and September to October near $30. Such a sharp concentration on a single date raises the question whether the market faces a genuine physical shortage or simply a wave of short covering ahead of tomorrow's settlement. Experience suggests the latter predominates. As delivery approaches, large commercial participants typically roll positions forward to the next month, leaving the nearby contract thinner. Active traders rarely operate closer than the 3-month benchmark, which serves as the prevailing reference. The volume underlying the current backwardation is therefore likely modest rather than measured in millions of tons. A relatively small shortfall can still produce outsized price effects in an illiquid near-dated contract. When spreads last reached comparable extremes in 2021, the exchange introduced emergency measures to prevent disorderly conditions. At present, those levels have returned as the prompt date nears, yet intervention appears premature. Copper remains the world's primary industrial metal benchmark, traded actively in New York and Shanghai as well as London. Arbitrageurs who can move physical metal across these venues possess the capacity to narrow discrepancies without official interference. Copper is not a small niche market like nickel, where squeezes have previously forced exchange action. Authorities would need to witness far more extreme dislocation before disrupting normal market function, and they will strive to avoid that outcome. Aluminum presents an almost inverse picture. Stocks have fallen to the lowest level since 1990. The nearby spread remains a modest $8, yet 95% of remaining inventory consists of Russian metal that American and European buyers cannot legally purchase. The exchange classifies the position as a dominant holding because one entity controls more than 80%. How much of that metal is actually available to a consumer needing supply next week is therefore limited, yet the spread shows little stress. One contributing factor traces to the Middle East, where a substantial share of global refining capacity is concentrated because aluminum production is highly energy intensive. Disruption to shipments through the Strait of Hormuz has reduced flows from Persian Gulf smelters, tightening the market independently of the Russian inventory issue. Commodities historically find pathways to end users through intermediaries even when direct channels close, so Russian metal continues to circulate in some form. Yet legal restrictions still constrain accessibility for many Western fabricators. On the supply side, the world's largest mining company recently reported that copper now constitutes more than half its revenue for the first time, with realized prices up 35%. Yet output from its Chilean operations is declining as ore grades fall and mines age. Chile's own copper commission projects national production down roughly 2.6% this year. Supply is responding slowly because the interval from discovery to first metal stretches across many years. Mining companies have focused more on consolidation than expansion in recent periods, and the results are now visible. Revenues rise with higher prices while volumes struggle. The combination of declining grades, rising energy and steel costs, and lengthy permitting timelines collides with unprecedented demand from energy transition projects, artificial intelligence data centers, and broader electrification. Organic expansion may cost between $16,000 and $30,000 per ton of annual capacity, while acquiring existing production through takeovers can exceed $100,000 per ton once premiums are paid. Despite the apparent cost advantage of building rather than buying, the industry has not accelerated organic projects aggressively. The remaining deposits are more complex, more remote, and more capital intensive than the low-hanging fruit already exploited. Political risk compounds geological constraints. The forced closure of a major Panamanian mine demonstrated that copper scarcity can arise from regulatory decisions as readily as from ore depletion. Negotiations toward a possible restart continue, and any resumption would meaningfully ease global balances while also serving United States supply needs given the mine's geographic proximity. Markets tend to price future disruptions only after they become visible rather than in advance. Speculative premiums can appear and later deflate, yet the structural shortage of new projects in the pipeline points toward tightening conditions that may become more apparent relatively soon. Increased scrap recovery offers one incremental source of supply, but the larger increments once projected for recent years have underperformed, leaving the forward outlook for mine production relatively thin. Demand composition itself is shifting. Federal Reserve industrial production data show a second consecutive monthly rise, with manufacturing expanding in the second quarter at the fastest annual rate since 2021. Strength concentrates in computer and electronics products and business equipment, categories tightly linked to artificial intelligence infrastructure. Housing starts, traditionally a major copper consumer, printed their weakest single-family reading since 2022. The older demand driver is therefore being displaced by a newer one centered on data centers, electrification, and related capital spending. These projects often proceed with less price sensitivity because the underlying investment thesis rests on strategic necessity rather than marginal cost. In Europe, elevated gasoline and diesel prices have accelerated electric vehicle adoption. In some markets, 8 of every 10 new cars sold are now electric. Power remains cheaper than liquid fuels for transportation, supporting continued growth even if metal prices climb further. Factory utilization near 76% suggests the expansion remains narrow rather than broad-based, concentrated in artificial intelligence, electronics, defense, and electric vehicles. Economic growth has become increasingly dependent on the successful rollout of these large-scale, debt-financed investments. Copper eventually encounters substitution risk once prices rise far enough that designers switch to aluminum or shelf projects, a constraint gold never faces because its primary buyers are not consuming the metal. The gold-copper ratio over long periods tends to favor gold during sustained hard asset cycles, precisely because industrial metals meet demand destruction thresholds that monetary metals do not. Silver has already illustrated the pattern. Once prices moved well above $100, industrial users began exploring alternatives more actively. At current levels, copper still sits below the point where substitution becomes widespread, yet the ceiling exists and will eventually assert itself. Positioning data show speculative longs at or near multi-year extremes, depending on the series examined. When physical tightness and crowded speculative exposure coincide, distinguishing an ongoing squeeze from a trade nearing exhaustion becomes difficult. Momentum that produces only shallow corrections draws additional speculative capital, just as occurred during gold's multi-year advance when corrections never forced significant position adjustments. Rising stop levels move the potential exit zone closer to the market, yet the long-short ratio has not reached the extremes recorded earlier this year, leaving room for residual short covering. Recent days have seen the backwardation ease somewhat, removing some near-term pressure. While the broader metals complex experiences profit-taking after an extended run, silver, platinum, and palladium have declined 2 to 3%, gold roughly 1%, and copper about 0.5%. The move appears to reflect ordinary consolidation after failed attempts at new highs rather than a fundamental shift. Copper represents a shortage of physical material. Gold represents a shortage of trust. Both can advance simultaneously without conveying identical messages about economic strength. In earlier cycles, a rising copper-gold ratio signaled robust activity that would eventually prompt tighter monetary policy and higher funding costs negative for gold. Today, both metals rise together because scarcity operates in parallel domains. Tangible industrial supply constraints for copper and monetary scarcity for gold. Central banks have led investment demand for the latter, and the investor base is widening further as attention focuses on fiscal trajectories. 30-year Treasury yields have touched 5.32%, the highest since 2007. French yields have returned to 2008 levels. German 30-year paper has commanded the highest yields in 15 years, and gilt yields press towards 6%. Rising real yields normally constitute a powerful headwind for gold because the metal generates no income. Yet gold has advanced from below 4,000 to well above that threshold, even after today's modest retreat. The market appears to be repeating the 2022 to 2023 experience, when aggressive rate hikes and a shift from negative to positive real yields produced only sideways gold prices rather than the 5 to 10% decline that pure interest rate models suggested. Non-yield sensitive buyers, principally central banks, absorb supply. Western exchange-traded fund demand has remained relatively muted until recently because those investors still weight dollar strength, yield levels, and funding costs heavily. Asian and other non-Western investors place less emphasis on those variables. The United States debt clock recently crossed $40 trillion and continues rising at an accelerating pace, broadening awareness that current debt stocks leave little room for substantially higher yields without imposing an unsustainable interest burden. Much of the existing debt sits at the short end of the curve, so any rise in policy rates would quickly elevate servicing costs. Market pricing that once embedded aggressive rate hikes has moderated, with some major institutions now suggesting the next move could be a cut rather than further tightening. Liquidity typically improves in September as market participants return. Whether gold then initiates a year-end advance or encounters renewed selling depends on several conditions. A sustained move above the 200-day moving average and restoration of longer-term positive momentum would be constructive. Resolution of geopolitical conflicts and containment of inflation pressures would further support the path. Technical levels suggest that holding above 4,200 and breaking decisively through 4,500 could attract renewed exchange-traded fund inflows and open the possibility of revisiting 5,000 before year-end, with potential for new records thereafter. The structural reasons investors have accumulated gold over recent years have not disappeared. The recent correction, while painful and deep, found buyers willing to re-engage near the 4,000 area. Silver has experienced violent swings, rising nearly 2% one day and falling around 3% the next. Industry data indicate a sixth consecutive year of market deficit, projected at 46 million ounces this year and wider than the prior year. The cumulative shortfall from 2021 through the current year approaches 762 million ounces. Deficits cannot persist indefinitely, yet the figures incorporate investment demand that has partially faded after the sharp correction earlier this year. Industrial consumption may also have moderated at elevated prices, and the prospect of increased scrap recovery exerts additional pressure. Silver remains roughly 50% dependent on industrial use, so higher prices eventually elicit a demand response. Near-term prospects appear more tempered than those for gold. Silver may track gold toward the $100 region if momentum resumes, but another period of reassessment is likely once those levels are tested. The gold-silver ratio has struggled for directional momentum. A recovery in gold would normally compress the ratio through silver outperformance, yet that pattern has not fully materialized. Technical attention focuses on the 73 area. A sustained break higher could open a path toward 100 on a purely technical basis. Silver retains its character as gold on leverage, yet the leverage applied this cycle has been more measured than during the previous parabolic phase. Many participants who entered late during the earlier advance suffered severe drawdowns when prices nearly halved in a matter of weeks, leaving residual caution. If forced to select a single hard asset for a multi-year horizon, gold would take precedence, although a diversified basket including platinum and copper would be preferable. Backwardation can generate positive roll yield for holders of long futures positions, effectively paying the market participant to maintain exposure, yet such conditions can reverse rapidly. Metals more commonly trade in contango because the cost of financing physical inventory must be reflected in deferred prices. Short-term interest rates largely determine the size of that contango. Rate cuts would reduce the financing hurdle and improve the appeal of holding futures. Extreme backwardation has recently concentrated in energy and soft commodities, delivering substantial roll benefits, while the metals complex has remained better behaved. Equity holders of mining companies benefit from higher realized prices and strong dividends, yet broader equity market valuations appear elevated relative to the rising funding costs now faced by capital-intensive industries. Hyperscale technology firms have shifted from net lenders of cash to net borrowers, and higher yields increase their cost of capital. A balanced approach that combines physical metal exposure with selective equity positions therefore carries advantages, tempered by awareness of equity market risks. For a typical portfolio, an allocation between 5 and 10% to hard assets appears prudent. The broad commodity complex has advanced roughly 28% year to date, while the equity benchmark has risen around 20%, and over the past 12 months, commodities have outperformed by a wider margin despite the technology sector's prominence. Such exposure helps mitigate the impact of supply tightness and geopolitical shifts that continue to reshape global resource markets. The copper trade would lose its foundation if tariffs were fully withdrawn and tightness elsewhere began drawing metal back out of the United States, or more dramatically, if expectations surrounding artificial intelligence data center build-outs and associated power demand were suddenly revised lower. Those scenarios remain the primary risks that could unwind current positioning. Until such developments materialize, the dual scarcities of physical material and monetary trust continue to support both industrial and monetary metals. The path forward requires careful monitoring of warehouse flows, yield dynamics, and the evolving balance between speculative positioning and underlying fundamentals. Gold's ability to advance in the face of rising long-term rates demonstrates that trust deficits can outweigh traditional opportunity cost calculations, while copper's physical constraints illustrate how energy transition and technological investment are redrawing demand maps faster than supply can respond. Together they paint a market environment in which scarcity, both tangible and intangible, remains the dominant theme for the period.